Is it recording now? Okay, now, yeah, I was going to get to that.
Perfect.
Okay, we'll start with the roll call. I'm here, Tom
Here.
and Combe,
I'm here.
and Michael is not here. So
Michael's
that's all. Okay,
So we have a quorum.
and any comments on minutes?
I shared one point with Diane. It was a typo, and but other than that, we're good. On my
Okay.
end.
And let's get an approval for that then.
So moved.
A second, all in favor?
Aye.
Okay, and then we will hear from Brian on investment performance, but it's a happy story, right, Brian?
Oh, it's been a little rough year, a little rough start to the year.
Oh, I'm stuck the year past, I'm sorry.
Oh, well, yeah, I guess, right. You extend your horizon, it looks a little bit better.
Right,
Now, for some reason, this is not the good part of working home. I lost video in the sense that I can't see you all. Am I coming through?
You're looking terrific there, Brian.
We can see you.
Okay.
Um,
Give me 1 second. I'm just gonna. I'll carry on since I'm fine.
okay.
So,
And then which of the attachments are you walking us through? Because we got a couple, I think, that were distributed. Just want to make sure
Diana,
I'm opening the right one here.
Mhm. So it was the most recent one. It's
It's the updated town.
correct. It's the one that said updated town of New Canaan, April 5th.
Perfect.
The other one that I sent was an overview on fees, which we could either talk about or not. But the updated one you should start with.
Perfect.
okay.
okay. So yeah, that is a bigger one. So does everyone have that open? It's 62 pages. I'm not going to go through them all, but do you have that in front of you?
Yes.
Well, kind of, as
Okay.
much 2 pages can be open, but
Yeah, because if it's up on the screen again, I don't know why I lost video, but so yeah, as I was mentioned, this performance update is through February. I don't have the town's performance through March, but I give you kind of an update on the markets. And really, it's a strange market because how equities and fixed income have both underperformed. And even through March, fixed income has performed worse than equities, which you don't usually see. Fixed income tends to be a flight to safety. But the big story this year, besides the humanitarian crisis of Ukraine, I think it's really about the Fed and raising interest rates. So let's start on page 4, and that'll give us the backdrop, and it will tie very closely to the town's performance results because the town's performance is all indexed. So just starting on page 4, focusing, and I'll focus on the year to date. I know it's short with 2 months, but you see in the middle column, US stocks down over 8%, and non-US stocks have fared better. I think that's mostly a result of the high valuations for US stocks coming into the year. So non-US stocks were only down 5.6%. Fixed income, now this is what we're talking about, is the bigger story. So fixed income on a year-to-date basis down 3.3% as of the end of February. If I gave you a quick update through the end of March, fixed income as measured by that broad bond index is down 5.99%. And that's all because the markets have been anticipating the Fed increasing rates. The Fed did one small hike. And so as rates go up, bond prices go down. It's the inverse relationship. So that's really summed up here on page 4. If we go to page 5, I usually don't spend a lot of time on the sectors, but it's just to give context in the sense of energy. Not surprisingly, what's happening with Ukraine and Russia is the only sector that's up. You see up an astounding 26% just on a 2-month basis for energy, that middle column, where all other sectors have been down for the year. And not surprisingly, like sectors like IT and consumer discretionary, kind of bore the brunt of that. And those were some of the higher flyers prior to this interest rate environment. Page 6, if you're with me, is just showing, I think this is important with respect to the yield curve, because rates don't move up together or in parallel shifts. And so the shorter end of the yield curve has moved up much more than the longer term. Looking at the 2-year yield, you could see where we were a year ago with that red line and the teal line where we are. So in the 2-year, the yields have gone up 130 basis points, but the 10-year yields have only gone up 39 basis points.
So that means a recession.
Well, yeah, you bring up a good point, Neil, is what the yield curve we're looking at is when we've seen an inverse yield curve, meaning short-term yields higher than longer-term yields. That has been, at least if you look at the 2-year, 10-year yields, that has predicted, I think, is 7 out of the last 8 recessions. Because what it kind of foreshadows is, growth is going to be slowing with the Fed, with the central banks increasing interest rates. So that is something that, bears watching. The economy's still doing okay up to this point. I think the wild card is what, how long does oil stay high and for how long? So the longer term yields, like the 10-year, that's usually more reflective of what the markets think growth and inflation will be over long periods of time. But the 2-year is more reflective of where they, investors think the Federal Reserve is going to go to. So yeah, yes, more to come on this inverted yield curve. We wrote a paper a couple of years ago back in 2019 about it. I wouldn't be surprised if we refresh it, and glad to forward it to the committee. And so on page 7, if we flick to page 7, this is just looking at the different segments of the fixed income market. And I'll just focus in on the left-hand side with respect to credit quality, investment grade corporate bonds. This is something that we've talked about in the past. So investment grade credit is down 5% year to date, more so than treasuries. And that's because when you have this risk off environment, you have spreads start to widen, and credit spreads were at historical tights above treasuries because every investor was looking for yield. Same goes for the high yield market. And, that could be a potential area in the future that we look if we want some return enhancement for the portfolio. We talked about it a year or two ago, and I think rightfully we didn't move into investment grade to get additional yield because it was just so rich. Any questions so far that I can address?
No, I mean, we'll get as
Okay.
we go.
Yeah,
Right.
good. Okay, again, because I can't see you all, it's more like a telephone call. So on page 8, I included this slide just to give some context to the backdrop of what we're seeing in the geopolitical environment. Our team went back and looked at other geopolitical sell-offs, and the takeaway here is, yes, there's short-term reaction to the markets around any kind of uncertainty, but if you look 6 or months or 1 year later, including the Ukraine conflict from 2014, well, while not as big as what we're having now, the markets were higher 6 or 12 months later after they saw through these periods of uncertainty. So kind of just a message of staying the course, and we don't know how quick or when it will rebound, but eventually it gets back to some fundamentals.
So we've sort of done that, right? Well, we have done that. And
yes, we have.
It served us well between ups and downs and all that. It's tricky running for yield, right? Or for credit to maximize a return.
Right.
And in the end, doesn't everything come back to the mean?
Well, yes, reversion to the mean is a powerful concept. The question is always like, which mean?
Yeah,
Because
that's
things can, what time period do you look at and what's relevant? And so, but yes, there is reversion to the mean. It's just, yeah, what mean? So with investment grade credit, that's obviously, as the name implies, still high quality. And over longer periods of time, and I could even show this to you, you've gotten some yield enhancement for taking on some more credit risk versus treasuries. But high yield, we think of in a different category, even though it's a fixed income investment, more of equity like, because it doesn't protect in down environments. Treasuries are the best asset class besides cash, but
Yeah, it's
so
kind of
we do look.
interesting,
Yeah.
Brian. I just know, going back to your page 7, it seems like the investment grade credit is taking it on the chin in a way that's noticeably worse than the
Noticeable.
bonds, right?
Yeah,
And you would
you're
have thought
right. Yeah.
if you were gonna dip your toe in the water a little bit, you'd say, well, I want the investment grade credit, I want, I don't, because some of these bonds, they sit out there, they're either unsecured, or even if you're talking apples to apples and nothing's secured, oftentimes these bonds have nice big yields, and you think, oh, well, that's because they're going to be riskier. Let me go with this really high grade corporate name. And it, just looking at the way you slice the data on page 7 there, I think there's no situation which the investment grade, so-called bank debt has done better than the bonds.
The high yield, you mean, or the?
Yeah, the high
or
yield.
Yeah,
Yeah.
right. If you this is looking at year to date 1 year. Since you bring that up, Tom, I'd have you flip to page 15, and page 15 is just looking at broad indices, but at least it gives us history going back 10 years. And so coming back to the corporate versus treasuries, if you were to look at 10 years, if you went to the fixed income section towards the middle and you look at Bloomberg US credit corp 5 to 10 year, right?
Yeah.
And if you go all the way out to 10 years, that return was about 4%. You'd have to go further down the page to find treasuries of 5 to 10 year maturity, and that's at 2.2%. So over longer periods of time, there's been that yield enhancement for corporates over treasuries. However, in the environments like this year or COVID, any kind of market crisis, spreads widen, credit underperforms, and treasuries are your best asset class. Yeah.
That makes sense.
High yield has had a higher return, but it's much more volatile, and it does not protect in those times of crisis.
Yeah, right.
So I love taking any questions, and I'm going to leave it open for questions once they get through the performance of just the portfolio. So page 9, that'll give you the snapshot of how the pension plan was doing through February. And from a year-to-date perspective, down 6.17%, and that's reflective of the indices that we just talked about, the equity and the fixed income markets down. So on a 1 year basis, still positive. We'll see how that fiscal year-to-date holds up. Of course, we came off an incredible 2021 ending June of last year. And then, looking out inception, that we go basically 20 years, 7.93, that absolute returns good in context of our discount rate for the plans. And so well above those discounts rates that we've had, recently or in the past. Down below staying on page 9, just cash flow. We have contributions that come in on a regular basis. We also have distributions, and we use that as an opportune time to rebalance. And as a reminder, if the equity or fixed income asset class got 5% away from its target, then we would look to rebalance. And so we're about 2% off, you can see, from our targets, from a policy targets. So it's something that we monitor on a daily basis.
Yep.
Page 11 is the Opeb plan, and it's the same asset allocation. It's the same 3 funds. So the year-to-date performance is almost on top. It's down 6.23%. The only difference is just different timing of cash flows. That's why it'll differ from the pension plan. The Opeb plan really has very little cash flow in or out, whereas the pension it's more active. And then fast forwarding to page 13, which is the Mildred Marsley Trust, the scholarship fund, just looking at that, slightly more aggressive asset allocation, just a little bit more in equities. It's down 6.31%, versus the other two portfolios, but same funds, just a slightly different asset allocation.
Right.
There's of course been questions about, I'll just make a comment about Russian securities. Russia is no longer in the indices. MSCI, FTSE, any of the major indices have taken Russia out of the indices. However, before all that, Russia only, you'd find Russian securities with respect to New Canaan's portfolios in that total international stock index, which is all markets outside of the US. And Russia's securities only made up 0.7% of that index. So relatively small part. Of course, it was mainly energy names. Index providers took the step in early March to take Russia out. So the Russian securities have basically been deemed as worthless. That's just what it is right now, because there's no trading, there's no price discovery. But there is a possibility, months down the line, that the market's open, whatever happens, that we get a value for those Russian securities. So they were never sold because they couldn't really be sold. There was no buyers or the markets weren't open. So they've just been really marked at a zero value.
Yeah.
So just context on that. From there, I have a lot more slides because, really on different asset classes, whether we talk about inflation, we talk about the role of alternatives, all topics that we've discussed at little points along the continuum. But I'd love to really open it up to the committee just for questions, and then we can go there. Unless you say, listen, Brian, just give us your perspective on this, and I'll start talking. But I want to make sure to leave room for the questions, since I know there was a lot, and especially with Michael, but I know he's not here this evening.
Right.
What would be best to address with respect to asset classes, and then more specifically the asset allocation for the town?
Right. I think
What's
we
top
get
of mind?
a couple of things. Asset, just in terms of what kind of asset composition we have percentage wise, equity versus fixed income. We always want to look at that. We typically consider looking at the discount rate. Whether we will do that this year or not. I hear there's some movement out there in terms of us being more in the middle, but we certainly would want to talk about that. Michael's products coming up, I'm not familiar with a lot of them, so we would depend on you sort of educate us on that. What else, committee?
Yeah, I mean, that all sounds right to me, Neil. I think I always find it helpful to discuss discount rate and, where we stand relative to our peers, if there has been movement there, and, so that we can take in the totality of, what's the marketplace telling us, but what are our, kind of peer communities telling us, and where does that find us? So that I find is always helpful.
Yeah.
Yeah, I think looking at page 18, the other communities and the level of risk they're taking and their assumptions too. That was the page that I thought was most interesting to find out, how we stack against other communities and are the assumptions right going forward.
Right. Good. Let's go there. But let's go first to page 17, if we could, and before we go to the other towns. And so this is looking at, and Tom brought this up, is here's our policy targets. 42% to U.S. equities, 23% non-U.S., and then 35% to fixed income. To the right of those policy targets are Vanguard's forecast for those asset classes over the next 30 years. We use a 30-year time horizon because that's usually what the actuary uses. So for instance, at the 50th percentile or the median, looking out for U.S. equities over the next 30 years, we think it'll be 5.2%, and you can see the distribution around that. So if you take into consider that those asset class forecasts as well as correlations between the asset classes, right in the middle of the page is the return distribution for the town. And so at the median, we're forecasting a return of 5.62%. And realizing, say, at the 75th percentile, we may get a return at 6.3%. So, it is lower than what the town's current discount rate of 6 3/4 is. So that would be the distribution that I think an actuary would look at, realizing the median won't exactly happen. What I would say, just in light of this current environment, is that this is probably a low point because these are using asset classes forecasts as of December. And in about a month and a half, 2 months, we'll have it as of 3/31. And I think those numbers will look better because equities have fallen, so the valuations have gotten better, and then yields are finally up on fixed income, so fixed income forecasts will be higher. So I think this forecast will be higher when we rerun it for the town in a few months. With that said, the trend for discount rates has been coming down for towns, whether we look at the next page 18 in Fairfield County, or just the national average. So our return forecasts are similar to other investment banks, not the same, but similar. So plans have been reducing their discount rates over time. So page 18 gives us a snapshot of other towns in Fairfield County. There's a couple missing. The financial statements weren't out for all towns, so we can look to update this in another week to see what other towns have populated. So my observation, just looking at this, not that we should use other towns to set New Canaan's discount rate, is we're on the higher side of other towns. The other towns like Norwalk, Fairfield, they have a higher discount rate. However, both of those towns, do use alternative investments, and I'm just using broadly speaking. The alternative asset classes will have a higher return assumptions than the public asset classes.
So what do they use? What would be an example? Do you know?
Private equity and private real estate are the main ones that come to mind.
Really?
Yes.
Now, I'm used to the institutions like nonprofit colleges or hospitals doing that.
Right.
But I didn't realize relatively small municipalities were stepping into that,
Yeah.
So
Fairfield's pension plan's around 500 million. I don't know what Norwalk's is off the top of my head. I could look it up. So they're still sizable where they can get an allocation.
Yeah.
But the other thing that's really important, the color coding, like New Canaan's funded status is well above. We just color coded over towns that are over 100%.
Yeah.
I think using the CAFR, you're closer to what, Diane, 120 or something. So, I mean, just a phenomenal funded ratio.
Yeah.
And that's using a straightforward, disciplined approach. And so I don't think we've been, penalized by any means. I think we've had strong returns, following a disciplined approach, diversified portfolio, and keeping costs low.
And with the market returning to a yield for fixed income, doesn't that almost put a little damper on alternative investments too? I might not get the maximum yield like I would with private equity, but it's a lot safer than.
Well, it's certainly more transparent and it's certainly more liquid. So no question about that. So that's with, say, with private equity, you're giving up, you have to have a long time horizon, over 10 years, and you don't have as much transparency. You have to wait a long time for those returns.
Yeah, and that 10-year thing with liquidity is something that I worry about too. You know,
Right.
waiting to get out of the deal. I don't know, other
Right.
people, I didn't realize other municipalities were using it though. That's just sort of interesting.
What type of
Typically,
fees are they,
yeah, go
Brian,
ahead.
for private equity?
I'm sorry, I missed the question. What
Yeah,
about private equity?
private equity has high fees, right? So that's one of the trade-offs. Are these towns paying substantial fees to engage in private equity?
So the general answer was certainly it's going to be much more expensive than any public asset class. And the fees are going to, so yes, the fees are much higher. The fees are going to be contingent on two things. One is the fixed fee is higher, right? You know, there's usually a flat fee that managers get. Sometimes you hear of like 2 in 20 or 1 in 10. So the flat fee of 1% or 2% is higher. But the other part of fees is contingent on how they did on performance. And usually any private manager or private equity manager will get a percentage of the return after hitting a return hurdle. And it could be 7%, it could be 8%. Different private equity managers have different hurdles. So you give up a percentage of the profits if that private equity manager is above that return hurdle. So one argument for private equity would be with those higher fees is like, well, they're earning a majority of their fees if they outperform that return hurdle. If they do really well, the town or the investor is going to do really well. But not all private equity managers do well.
Yeah, agreed.
Yeah.
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 And also, you know, I wonder, do you get the same credit from the rating agencies when they look at your capital? They must discount the private equity more than they do rated securities, even if they're triple B?
I don't know how the credit agencies would factor that in. I think they would, the credit agencies, when looking at the borrowing cost for a town, I think they would be more contingent on your funded ratio. Because if you're unfunded, you know, that's a form of debt, right? You know, you
Yeah.
have to make that up. And so
Yeah,
Right.
I think it's more contingent of the credit agencies are more looking at your funded ratio. It was my understanding.
yeah, that would make sense.
Mhm.
Well, I don't know, are people feeling courageous and exploring those projects? You know, we can go on more. Maybe I'll come
Yeah, I
up
mean,
with-
look, I kind of feel like, you know, one, it's important to have this conversation at least once a year and revisit it.
Right.
Two, you know, I feel an important point you mentioned is that given our substantially over 100% funded status, it takes a little bit of the urgency off of getting this discount just right.
Yep.
And, you know, some of the other sort of more deliberate and methodical policies that we, you know, have served us very, very well. And so, you know, I don't think there's, you know, an urgent need for us, you know, to try to manage this and to really get it absolutely precisely correct. If someone could, you know, hobble together an argument that says, oh, you know, you're really starting to look a little off market here. You know, I'm not sure that I'm anywhere near that conclusion, to be perfectly honest.
Yep.
And so, you know, it's good to see people are trending downward. We're taking a look at it. We've had this conversation. I think this is just, you know, Neil and Colin, you'll kind of come to understand this. This is yet another step on our journey. And, you know, I'm not sure I see a need for us to change it, but, you know, I think take all this analysis and discussion, you know, park it for our next time we visit this. Michael might have a view on it the next time we speak, but
Yeah.
I don't see an urgent need to change this, even though, you know, I fully acknowledge that some of our peer communities here are kind of trending back to the left a little, and that's fine. We understand why they may be doing that, and that their circumstances might be a little different that would cause their timing of retreating to the left to be a little bit different than any decision we might feel we might need to make in the future.
Yeah,
Right. I know one of the, oh, sorry, Neil, do you have a comment?
no, you go, and then I'll come in.
I think one of the just broad asset classes Michael was talking about is, what about a multi-factor or a multi-asset allocation fund that's looking across different asset classes in order to protect some of the return that the town has generated. And so I've never brought that really concept to the board, because if you went to page maybe 27, I know it's a very simple slide, but it just
Yeah.
captures how we think of these other alternative asset classes. And so anything like a multi-asset class fund or any type of hedge fund that is across different strategies or long short, we consider that like an absolute return strategy. And so you could see, what's the purpose of that? We feel that would be in the bucket of improved diversification. It's not really there for return. And Vanguard has a couple of those types of strategies, and I've included them in the book, but the returns are very low, like just about around cash. And so you get the diversification versus other equity or fixed income asset classes. They're non-correlated, but you're giving up return. And so since the pension plan, the Opeb plan have a long time horizon, I think equities remain, suitable for that long-term horizon of growing the plan and growing the funded status, while the fixed income should be high quality and be that ballast and protects in those down environments. And that's your diversification.
So put yourself in your seat 1 year from now, after a 10 to 20% correction, which is what Jamie Dimon said in this article, because of
Right.
the not that he's the prophet, but
Yeah.
there's more pressure on all of us then, right? What would you do anything different at that point in time, even?
No, if I think about what we've done, at least with COVID, we were down 20% and we rebalanced because those policy, our asset allocation moved outside of the policy ranges.
Yeah,
And what did we do? We sold the fixed income, we bought equities, and that was the most opportune time to rebalance. We didn't know when that would reverse. That was March of 2020. So we did that. Of course, you've been with Vanguard. I wasn't with you in 2018, but we saw a similar reaction with our clients where when we stayed disciplined and rebalanced, it led to good results. So no, I wouldn't say doing anything different at that particular time.
yeah.
If we're down 10 or 20%. And I included, kind of to that point, where did I put it in the book? I go to page 35, 35 or 36. But we'll start at 35.
Yeah.
Or 30, you could even start at 34. This is looking at, to your question, downturns. We've had 9 bear markets since the 1980s. Bear market, a correction is usually down 10% from your peak. Bear market is down 20%. That's how the market defines a bear market. So you can see we had 9 bear markets since the 1980s. They come ever so often. No one can really predict them, right? And including the Fed. And so we had those down markets, we had those recessions. But if you stayed focused on that long term and the objective of the plan, you came out ahead.
And so,
page 35.
Brian, what would you, because this all makes sense to me, right? And
Right.
we were all sort of cautiously optimistic, but determined to live by the policy rebalancing, and we can all feel really good that it worked out. But
Right.
what I would say is, one of the concerns, as I remember it, was Michael suggesting, what sort of downside protection do you see, sort of similarly situated investors, such as ourselves in these funds, in circumstances where not only do you see correction slash bear market in terms of where the equity values are going,
Mhm.
but also in a rising interest rate environment, so that fixed income values are going down because interest rates are
Right.
going up,
Right.
right? And so you can, buy new fixed income and, okay, and I'm grabbing, relatively easy, relatively safe, not that terribly
Right.
difficult to analyze, or, new instruments, and you're going to get them and they'll have good yield, right? If you hold them to maturity. But on the other hand, you have, these sort of long since decided investments that are baked into some equity positions and fixed income positions, and both of them are plummeting. And so I think the question, as I remember Michael kind of posing it, is, are there alternative investments, other things that people are doing that protect a measure of the downside? Not that you're going to go
Right.
all in, but is there any strategy there? And I'm not sure that there is, but
Mhm.
certainly, a lot of discussion about going into private equity and grabbing some yield there, but not so much on the can we pick a winner side, but is there a
Mhm.
prudent, kind of new formula or new product out there that can perhaps protect the downside so that
Right.
we can, preserve some of the good news that we've experienced in the last 10, 15 years.
Um, yeah, so the asset classes that come to mind, or sub asset classes, would be more of those absolute return type of strategies that have very low correlation to the equity or fixed income markets.
Yeah.
There might be some sort of commodities, usually it's a multi-factor fund that might have commodities because those are uncorrelated, might have a long short strategy. So, investors can go short the market.
Yeah.
Um, those different types of investments that would give you low correlation. So it does diversify you. You're not down as much, but looking out, you may sacrifice return. You get the diversification, but you may sacrifice the return potential.
Yeah.
Another one, maybe, Tom, that I can think of is, but I don't see a lot of plans utilizing it, is in the equity space, what's referred to as a lower volatility strategy. And so looking into invest in stocks that are not as volatile, just as the strategy sounds. So more of your consumer staples, your utility stocks, uh, higher yield, less risk to the economic environment, and so they are less volatile. They tend not to fall as much in bear markets. So
Yeah.
that strategy is something that investors have employed. Um, and I think that could be a pivot of where you might have be in the cycle. It's like, maybe the growth stocks, if Neil talked about reversion to the mean, growth
Yeah.
stocks have been the story since 2008. Maybe after a decade or more, it'll be more of a focus on value stocks and yield, etc. Um,
Right.
However, the town has a broad portfolio. You own the total stock market index, so we have that in there. Just not, we don't
Right.
have a specific value strategy, specific growth. We own the total stock market index, which is 4,000 securities.
Yeah.
So those are the ones that come to mind, Tom.
Okay.
He mentioned a gold too that I said didn't have liquidity. And he said, no, they can actually structure them with liquidity. So I guess that would be one thing. Investing in gold, I would say I would never do that for a town because of liquidity. But he said, no, there are products that do it. We didn't get into it, but that would be one that he was interested in. He mentioned to me.
Yeah, there are products, and gold is typically seen more of an inflation hedge, and so gold I would wrap into that commodity bucket.
Yeah,
And
Yeah.
so if you went to page 24, whether we want to, commodities, the biggest representation in a commodity fund would be energy. So as I showed earlier, of course, commodities have done well because of the inflation concerns, but mainly because energy has done so well. So I put in page 24 as context is, it's a boom or bust cycle with commodities. And I think the same could be seen for gold. So, how did investors fare? Like, or how did they act? Like, you see commodities for so many of those years were at the very bottom of all these major asset classes.
Yeah,
And was someone going to be able to stick through, hey, why are we in commodities? It's consistently underperforming. So I'm just putting this in the context. So then over the 10-year average from the end of last year was the worst performing asset class. Of course, right now it's the best. So it's a very boom bust, very volatile asset class. It does do a good job of protecting against inflation, but just have to realize, the characteristics of the asset class.
yeah,
And so for the pension plans, I think of more of a total return investment, and that you've got that long-term horizon, and therefore it's equities. I think we talk about endowments or foundations where they have to, their operating budget is sometimes dependent heavily on how well the endowment foundation does,
yeah.
and they have to spend 5% from that portfolio. And I've seen those types of investors have more of commodities into their portfolio to
Mm,
protect against inflation, since the portfolio, they need to spend from it.
yeah,
It's not that pension plans don't, these huge public funds, the state level do, they tend to be in every asset class. But so I have more slides in commodities, but I just wanted to circle to that one.
yeah.
Right.
I suppose you could build an argument on hedging sector. If you look at utility tech and how big it is in the indexes,
Yeah,
and then how big it is, and I suppose you could say there's just too much tech, you
right,
know. But
right.
it seems like if you wait, it just corrects itself over time. In
It does.
the pension fund,
It does. And yes, it does correct itself, but the cycles can be long, right? So the
Yeah,
value growth story, growth has been outperforming with the exception of recently for over a decade. And so if you take a big tilt in your portfolio, I'm speaking you generically, to growth or to value, just realize it may be a long cycle before that reverts to the mean or reverses. And
yeah,
when that happens, who
Right.
knows?
Right.
yeah,
Good point.
yeah. Okay. What are there some things you think we should consider before we come up with our own list? You look and say, here's something needs to get some attention.
The only asset class that that I still think that could be prudent, but is by no means necessary, but from a diversification standpoint, would be the private real estate. And I put some slides in there.
Mhm.
When we think of private real estate, we do think that as a diversifier, but we think of it more in the bucket of risk reducing. We, like, say for instance, if we went to a 10% allocation in real estate, hypothetically, where would you take that from? Well, we would take that from the fixed income allocation, because over 50% of private real estate returns usually come from income, from the dividends that come from those properties.
Right,
So it's a diversifying asset class. It gives long-term income. Yes, it is less liquid than, of course, your fixed income fund. You do tend to have quarterly liquidity. Most real estate funds have quarterly liquidity. But even like COVID, some of the private real estate managers did not allow investors to redeem maybe their full amount, because they couldn't sell properties in that environment. So
right. But that is sort of an interesting one because if it was a small percentage and it would give you a little kick.
Yeah.
Um, I've seen a lot of people using that lately, individuals too. I do them, so
so
I,
so I
I think
included I
that
was
could
gonna
be.
say I included sorry, Neil.
I know, no, each one cuts, but that one I would definitely want to have a discussion about.
I included one slide on page 28, and then we're jumping around, but slide 28, this is just at the asset class level. The slide looks different because it's from a real estate manager that we utilize, but this is just looking at the asset class. This is not looking at their fund or anything. And this is over a 15-year time horizon. And you could see it just plots different asset classes based on return and standard deviation or risk over that 15 year time horizon. The green dot, the NFI Odyssey, that's the benchmark for private real estate. It just stands for Odyssey is like open-end, diversified, core, I'm blanking real estate. It's probably in the footnotes, but that green dot is representative of private real estate.
Okay,
That's the benchmark. So over long periods of return, you could see that the difference from REITs is not that much. Like you to the right of that is REITs. So over 15 years, they both return around 6-7%. But REITs are carry a lot more volatility. They trade daily, and they tend to have a little bit more leverage. So you get a lot more volatility, but over a 10, 15, 20 year time horizon, you might come out around the same. But in between, getting to that point is a lot smoother for private real estate.
yeah. Okay, we'll put that on our list.
Yeah.
Let's look at time. I'd like to finish the meeting by the.
Sure.
But one thing I wanted to ask you, the committee, and also you, Brian, is releasing these numbers. You know, ideally, what we would have done is had this meeting tonight and then gone to the Board of Finance next week, and you would have done the presentation there. Because you're not available, we can't do it next week, and then it may be another month. And I'd hate to not send out these finances for a month, and we're going to get dusty, you know. So Diane and I talked, and we thought we would just send them to the committee, that maybe we see how everyone reacts when they get it in their tablet, but only present if there was a request to do that. But I didn't know if you felt you wanted to stay adjoined to them, or Tom and Combe, you know, what do you think? I mean, you know, the thing is, they're a little complicated, so giving them out early, which we would normally do easily, could raise questions, and we just don't have Brian there the week of that. We can just reschedule it to the next month. But what's your feeling?
Yeah, right. I mean, I would say just look, people read headlines, they're going to know directionally what these results are going to reveal, right? So it is true that unless you have someone like Brian take you through them, they can raise as many questions as they're meant to answer, right? Which is the danger. You know, look, I think on balance, I would trust our fellow board members, you know, to read this, you know, kind of park the questions they're going to have until Brian's available, and to reach out to any one or more of us if there's, you know, an urgent concern that they feel like it needs to be addressed. And, you know, we can share with folks that we went forward with this meeting anyway. Brian took us through in, you know, the thorough way he always does. We didn't have Michael there, and so we're going to continue our conversations.
Exactly.
And we'll report at a further Board of Finance. But I think on balance, I'd come out, you know, sharing them, as you say, because the numbers do get a little dusty if we let a little too much time go by. And, you know, a good number of our members of the committee are going to be at least as good of finding their own way through this as the three of us, it seems to me.
Yeah.
Question though, if we didn't release it, there'd be updated numbers before the following month, right? It would be the first quarter. So there'd be an updated deck.
Yeah. Okay, so I think, Tom, you summarized it well. I think we'll send them on. We'll get Brian on a future call if we have to. Brian, I hope you're okay with that.
Completely. Yeah. Whenever I'm needed, I'll be there.
Okay. And Diane, what do you think of that?
Yeah, that sounds good. I mean, do you want to maybe have Brian come the following month, May 10th, or do you just want to see if the full board asks for that? I don't know if you want to just offer it, or do you want to wait and see?
I like the investment manager to meet the Board of Finance at some point, you know, And other than that, when would be the time that would happen? It's so hard to get these meetings, you know? I
How's your
guess-
calendar? I was gonna say, how does Brian's calendar look for maybe May 10th? This way it's still fresh in the committee's heads. Maybe
Yeah.
the numbers might be a little more, maybe we might have one more month.
Yeah, so
Yeah.
May, you take us through March results. Does that seem right, Brian? Assuming
Yes,
May 10 works on your schedule, that would be what you'd present on?
Yeah, I'm looking at it now. I'm free May 10th, so I could come up and we would use, right, we wouldn't have April, we certainly would have March returns.
Yeah, I think that sounds good.
It
I think
does.
that's- So yes, Diane, your idea is good. Okay.
Okay, so just so I'm clear, we are going to distribute this to the full board, this packet.
Yep.
And just say that Brian will come and give even, give this information out, but update it through March. But at
Right.
least it's getting them to starting to look at what the committee has addressed and what the committee
Right.
is talking about, right?
Yeah, and that way they know they're gonna talk to him in person, or be able to kick tires or whatever. Good, I think
Okay.
that's good. All right, what else do we need to do, Diane?
That's it. So there's no decision on changing anything tonight. But if I,
I would say we reaffirmed.
right, keep the path,
Yeah.
keep on the same path.
Yeah, keep on the same path. We're happy to reopen this when Michael can join and we can go through this. But yeah, I think we were kind of all of the view of more helpful information, but we don't see a need to change course yet.
Yeah,
Right.
Yeah.
Good.
Do you want to have an RPAC meeting before the May 10th, like right before 6 o'clock again or 6:30, or do you think it's not necessary and just go right, just have Brian come to the full board?
I'm available to do it. We might not be the worst thing in the world if we had a particular question regarding the March results. You could preview it to us. Might not. You might appreciate that opportunity to go through it once and get the kinks out. If I don't know what you think about that, Brian.
Oh, I'm more than happy to meet with you
Yeah.
all before. I mean, we're right there, right?
Yeah, I mean,
Yeah.
Right in
look,
the same
we
building,
would-
right?
Right, we
Yeah.
would be promised to be mercifully brief if, it didn't really, there was nothing else there.
Sure.
That'd all be fine, but it probably seems like good practice to go ahead and get that in the books in any event.
Yeah, on balance, I would think I don't know what month we roll off, like what that looked like. I mean, like I said, March equities got a little bit better in March, fixed income got worse. Maybe on balance, the overall portfolio's down less, but
yeah,
I don't know what month we rolled off looked like.
Yeah.
Probably a good month.
okay. I think we're good. Does anyone have any other business or any other points to make?
No,
No,
Good, so get a motion to adjourn,
so
I'll
moved.
move. Second.
second, all in favor? Aye.
Good.
Brian,
Okay.
thank you very much for coming.
Yeah, thanks for your time, everyone. Really appreciate it.
Yeah.
Thank
Yeah.
you.
Always a
Okay.
pleasure to see you.
okay, thank
Okay,
you.
now.
Bye, I'm gonna stop.
Bye-bye.
Okay.
Bye.
Bye, committee.